So welcome back to my 5XYZ. Today we're going to talk about my 2022 investing strategies. This is kind of the part two of part one that was on Wednesday about the 2021 kind of news headlines that I think are going to be relevant and important for at the very least the first quarter of 2022. So standard disclosure and disclaimer, not a CFP, not a CPA, never took a finance course in my life, and I'm a long-term investor that does mostly dollar cost averaging of ETFs and index funds, and I've been doing this since 2012. I do not know what 2022 is going to look like, but I can make some educated guesses based off of some of the headline things that we talked about in the previous video. So the first being Omicron. The new mutation is going to make the markets maybe a little bit more skittish. We don't know necessarily what's going to be effective in terms of the vaccines, although I think I saw a news article saying that maybe potentially the Pfizer one was going to be protective. Still waiting to see what Moderna is saying, but by and large, the mRNA platform is going to allow us to engineer a new vaccine booster if need be. So I'm less worried about the long-term utility of vaccines. I think that's still going to be on the table. But anytime we see a new variation or a new variant, it's going to set the markets to be a little panicky. The markets are looking for an excuse to drop. Right now, we're on valuations that are at all-time highs, and it doesn't take much to get people to potentially panic sell or worry about a market correction happening or potentially even switching to a bear market. And so Omicron is going to be the latest to kind of make the market a little uneasy. The second is going to be kind of talking about inflation. Inflation is here to stay. We talked about how they stopped saying that it's transitory. And so inflation is going to be about 6%. I think it's probably going to stay high. I don't think it's going to go away all of a sudden in 2022. Hopefully it doesn't continue to go up, but we'll see what happens with that. But that's another pressure that people are getting kind of concerned about. Their money is not going as far. That's going to mean that less money is going to be flowing potentially into the market because money has to go somewhere towards paying for rent, expenses, other things like that. Other things are going to be the Fed debt ceiling. So in February, around the middle, that's when their deadline is going to be. And if the left and the right do their usual kind of baloney, it's going to push it to the wire and the markets will get choppy around that time. So just mark that in your calendar and note that maybe you shouldn't buy right before those couple of days. Give that week a break and then throw money on the volatility and the drops that ensue. And then finally, kind of talk about tapering an interest rate, how interest rates growing up could make growth stocks hurt a little bit. So maybe be a little bit more mindful about looking for blue chip stocks, dividend stocks, more mature companies, if you're going to try to make individual plays for long-term individual stocks. If you're wanting to swing trade, then the volatility that comes with this could be an opportunity for you. But you just need to be mindful of what the different factors are that are going to impact the price movements of what you're trying to put your money in. Because it doesn't feel good when you put your money in and then you see it turn red and then stay red hard for a month or two. If you don't sell, it's not technically a loss, but the psychological impact that has still stinks. And so for me, we're going to start with what my overall strategy is going to be for 2022, and it's simple. It's dollar cost averaging. It's lazy, maybe it's a cop-out, but it's tried and true. It's worked well for me since 2012, and I'm going to stop shying away from it like I did in the last 6 months. I got caught up in trading stocks, and I'm going to do less of that. I am going to just dollar cost average. I'm going to set aside a certain amount of money that I want to put towards potentially ETFs, okay? I think I'm going to do probably around 70 to 75%. Stocks, I'll probably do about 20%. And then crypto, I'm probably going to still stay to 5%. The last 6 months, I ramped up my crypto portfolio to about 5% of my overall investments in all kind of markets. And so for me now, all new money, probably about 5% will still continue going to crypto, but we'll talk about how I'm going to dollar cost average for each category. So for number one, we're going to talk about ETFs. For me personally, I get a lot of index funds exposures through my 401k, my HSA, and my Roth IRA. That's where I get the bulk of the S&P 500 or the total stock market, and that's what I'm going to keep doing. That by default with the 401k is going to dollar cost average every paycheck. So every 2 weeks, it's just going to be going into the market. For the HSA, I tend to do lump sum for that first month, and so that's just going to kind of go in, be done with it. And then for the Roth IRA, I'm kind of similar. I tend to do a lump sum. But in my Roth IRA, like I've talked before, I do part REITs, part dividend stocks, and part S&P 500. And so I'm going to stick to that. But for my ETFs in my actual taxable account, I'm going to stay with more sector ETFs. And so I have F discretionary and F technology that I have my highest proportion in, and I probably won't add as much as regularly to this one. I'll probably do a smaller percentage allocated to that. I do think technology and discretionary spending are going to still move well in 2022 as we're in this kind of still pandemic year number 3. But I want to start building up other sector ETFs. So I started opening a position in the financial, FNCL. I've done FENY or FENY, but I've been doing that mostly in my Roth IRA because it does produce a nice dividend. And if it grows and continues to kind of keep putting out dividends, reinvesting, I'd like to keep that just in a Roth IRA. And so for that kind of next $6,000 that I get from my Roth IRA, I'll probably put that towards FENY. And the other one is FIDU or Fidelity Industrial. So those are going to be the new 3 sector ETFs. I still need to get my F communications up to the level of F discretionary and F technology, so I'll still be putting into that. But those are the sector ETFs that I'm going to dollar cost average. I will probably do these on a monthly basis. So I'll set aside about a certain amount of money, about 70% or 75% of my money that I want to allocate towards ETFs, and simply at the end of every month put that in. The caveat being is if I see the market take a big drop, I might start putting that money in early after a dip. But at the end of the month, whatever's left over that hasn't been put in, just going to put those into those specific sector ETFs. Number 2 is going to be stocks. So for me, stocks, I've been playing loose with stocks for information technology and a bunch of different semiconductors, 5G ones, cybersecurity. I'm still going to continue with these plays, but I'm going to try to stick towards maybe more stable and mature ones, stay away from some of the more volatile ones. It was not fun watching Asana take just a bullet to the head. It dropped, I think, somewhere to minus 35%. That was not a good feeling. I'm still holding it. I'm still kind of averaging down on it, but I'm not going to average down a large amount each month. We're just going to watch it and let it ride. For these stocks, I do not want to pick things that are going to be volatile, okay? With the things that we have coming up in the next quarter, these kind of small cap stocks, these growth stocks, they could see some significant swings. And so for this, the dollar cost averaging for stocks, I will probably do it on a quarterly basis, meaning that I am going to be very selective that if I'm going to preemptively add some money in before that quarter comes up, I want to see that it's a good price point. So I'm going to look at the kind of technical analysis from the Bollinger Bands to the relative strength index. I want to see how earnings are doing before maybe I potentially kind of continue adding to it. And then once that quarter comes in, I might just dump onto those stocks that I really want to keep and hold for long-term positions. I'm going to stay away from trying to swing trade because I don't know when the volatility is going to come except for potentially that Fidelity, or not Fidelity, but the debt limit kind of in February. But by and large, I think I want to stay out of volatile assets. And so that's going to be kind of what I do with stocks. Just every quarter, try to stick to blue chip stocks, dividend stocks, or mature companies. For number 3, we're going to talk about real estate. Real estate is something I actually get passive exposure already through work, since we own some of our own practice locations. And so I'm technically in an REIT just through work. But I have REITs in my Roth IRA. I'm going to keep those positions open, and some of the $6,000 that I do for my Roth IRA might get to one or two of the REITs. But by and large, I don't think I'm going to increase that position a whole lot. I'm just going to see how things fare and let the dividends just reinvest on itself. In terms of creating a new REIT kind of grouping within my taxable account, I want to stay away from that. Those dividends reinvested, I think, do best in a tax sheltered account. So my SEP IRA, if I decide to increase the REIT, I might just convert my swing trading account to just real estate and just call it a day with that. In terms of number 4, bonds. So with iBonds is something that at Spin Change on Public is pretty kind of strong about, and I think he has a fair point. It guarantees you just a little over 7% for at least the first 6 months, and it's based off of kind of inflation to help kind of guide what that number they set. But that 7% is a pretty good return, and it's guaranteed, and it's backed by the US government. The max you can do is $10,000, and you can do it before the end of the year in December to at least get that first exposure. I don't know if I'm going to do 1,000 or 10,000. I'm still trying to figure out what I'm going to do, but I do think iBonds are something I need to seriously consider. the rates that it's promising, it's pretty good. There's no state taxes on it, and the federal taxes, if I use it towards like my kids' education, I won't have to pay taxes on that. And so 7% is a pretty sweet deal. And that might be something I might put some of my money, since I'm trying to hedge against some of that volatility. And so that's kind of just the basics for bonds. For me personally, my most exposure is just in my 401k through target date funds. I think it's about 9% of my target date 2050 that goes to bonds, and that's by and large my only bond exposure. I probably have about less than 5% of my assets to it. I probably should increase that to 10 to 15%, and maybe I'll use I-bonds to help me to do that. But this is something that I'm new and unfamiliar with. But it seems like a pretty straightforward thing on the US Treasury, and so I'll leave a kind of link in the description below. That's something you should consider if you want a guaranteed return. But if you're going ahead putting that money in, just know that it's going to be locked in for a year. And then the fifth and final is crypto. Crypto is ridiculous. It goes up, it goes down. There's a lot of kind of volatility due to what our government's going to do in terms of restricting it or governing it. I don't know what's ultimately going to happen. I still need to sit down this weekend and listen to kind of the meetings that happened this week and see if I can kind of tease out what the indications are going to be in terms of government regulation. But the infrastructure bill went ahead and caused the market to drop. And then I think it was this past Saturday that it dropped again. And so I try to go ahead and stay within that 5% exposure for me. And so that 5% of new money that goes in, I will probably add to the crypto market, but I won't do it as like a monthly dollar cost averaging. I want to hold that money probably on a quarterly and just wait for a huge drop, throw that money in, and then just continue to long holding the whole entire thing to wait for it to hopefully go up. Like you saw in my blog post, I'll go ahead and drop that in the description. But you want to take a look at the 1 year of Bitcoin and Ethereum and see the start and the end. And then just pay attention to all the all-time highs followed by huge drops. And just remember that if you're going to go ahead and participate in crypto, maybe it's best that you just look to get into after these drops and then just hold it. Because if you're looking from the start to finish, the 1 year gains look good. But if you bought it at all-time highs and then you sold it at the big drops, that's just setting you up for repetitive kind of losses. And so for me personally, I'm just going to dollar cost average probably on a quarterly, and then look for these big drops to go ahead and throw that money that I had on reserve, and then just hold it, watch it hopefully come back up, because I do believe this is something that's going to be sticking around for the long term. But that's my 5 for my investing strategies for 2022. If you have any questions, drop a comment. Don't forget to like, follow, and maybe hit that alert button so you know when the new ones are coming out. But appreciate that. Hope you have a good evening.